All right, welcome to the Druid Deep Dive. This is where we dig through the past to find some clarity for the wild world of DeFi. Today, we've got a really fascinating story for you. We're going to look at a banking crisis from over 100 years ago that holds some, well, surprisingly sharp lessons for our digital age. It's an incredible look at how history doesn't just rhyme, it repeats. But of course, just a reminder, this is all for educational purposes, definitely not financial advice. Let's get into it.
So I want you to picture this. It's New York City, 1907. The city is humming along, but inside the third largest trust company, a storm is absolutely brewing. You've got lines of panic depositors wrapping around the block, all demanding their cash, and the place is just hemorrhaging money. The modern financial world as we know it, it's about to face one of its very first great tests.
And the scale of this thing, it was just staggering. In a mere 3 hours, the Knickerbocker Trust Company handed over $8 million. Now, that might not sound like a lot today, but back then, it was an astronomical sum. And after that, they had to shut their doors for good. The panic was officially on.
So you're probably thinking, okay, that's ancient history. But what does it have to do with DeFi today? Well, the parallels between what went down back then and the risks simmering inside our decentralized finance world, they're not just fascinating, they are, frankly, a little bit scary.
Okay, so to really get how these crises happened, we've got to look at how the stage was set. In both cases, you had this risky, kind of unregulated underbelly growing in the shadows of the main financial system, just waiting for a spark.
The comparison here is just, wow, it's striking. Back in 1907, you had these things called trust companies. They acted like banks, but they got to play by looser rules. They only had to keep maybe 5% cash in reserve, while the national banks had to hold 25%. Now fast forward to today, and what do you have? DeFi protocols. They're also operating outside of traditional finance, they're offering insane leverage, and there's no central bank to call when it all goes wrong. It's the exact same game, just a different century.
And the result of all that freedom? A massive buildup of risk. In the decade before the panic, the money held by these trust companies just exploded, up 244%. That's more than double the growth of the more stable, regulated banks. The whole system was getting dangerously top-heavy.
So, the tinderbox was built, packed with fuel. Now let's talk about the spark that lit the whole thing on fire. You're about to see how a single failure, in both eras, kicked off a terrifyingly fast chain reaction.
In 1907, this cascade played out over days. It wasn't instant. It started with Knickerbocker, but that fear, it was contagious. The very next day, another huge trust was getting hammered. A little over a week later, a major brokerage house was about to go under, threatening to drag the entire stock market down with it. It was like watching a train wreck in slow motion.
70%. Just let that sink in. At the peak of the crisis, that was the interest rate for a simple overnight loan on Wall Street. A number like that isn't just a sign of trouble, it's a sign of pure, unadulterated desperation. The money, the very lifeblood of the system, had just vanished. Nobody was willing to lend to anybody.
Okay, now let's hit the fast-forward button to our hypothetical 2025 crypto crash. The trigger this time is different. Maybe a big geopolitical event sends prices tumbling. But just like in 1907, that one event spirals out of control, fueled by the exact same ingredients: way too much leverage and a whole lot of fear. But here is the terrifying difference: the speed. The 1907 panic took days to unfold. In 2025, over $3 billion in value gets liquidated in a single 60-second window. The whole cascade isn't measured in days anymore, it's measured in seconds. And this brings us to the part where these two stories just completely diverge: the rescue. We're going to compare how each crisis was stopped, one by a single, incredibly powerful man, and the other by cold, impartial code.
This quote, it just captures everything about the 1907 rescue. It's talking about one man, the legendary, the formidable banker j.p.morgan. When the whole system was on the verge of collapse, he didn't just step in with a bailout. He stepped in with brute force and his sheer unshakable will. Morgan's approach was like something out of a movie. First, he was like an ER doctor. He did triage. He went through the books of all these flailing institutions and decided who was sick but savable and who was already dead. Then, he coordinated the rescue, basically twisting the arms of his fellow bankers to pony up the cash. And finally, he forced a solution, literally locking them all in his library until they hammered out a deal.
Now, you could not paint a more different picture than the crypto crash of 2025. There was no j.p.morgan to look at the books. There was no one to coordinate a rescue. And there was definitely no one to lock the algorithms in a library. There was only the automated protocol, doing exactly what it was told.
The algorithm's method is just brutally efficient. It sees that a leveraged position has dropped below a certain value. It doesn't ask why. It doesn't care if you're solvent. It just triggers a forced sale of all your assets. And what does that do? It pushes prices even lower, which, you guessed it, triggers even more liquidations. It's a self-feeding death spiral, and it happens with inhuman speed.
So, what's the point of all this? What can we actually learn? Well, the parallels between these two panics offer some really timeless lessons for anyone, and I mean anyone, trying to navigate the markets we live in today.
Let's start with the big one, the tool at the heart of both of these meltdowns, leverage. It's pretty simple, right? You're just using borrowed money to make a bigger bet. It's a powerful, powerful double-edged sword that magnifies your wins, but more importantly, it magnifies your losses.
And this is a truth that is so critical to understand. You might be 100% right about an asset in the long run, but if you're using too much leverage, a short-term dip in the market, something that would just be a temporary setback for someone who owns the asset outright, becomes a permanent total loss for you. You get completely wiped out before you ever get the chance to be proven right.
Okay, next up is liquidity. It's one of those things we totally take for granted. We just assume that when we want to sell something, there's going to be a buyer ready and waiting. But as both of these crises show us, that assumption is incredibly fragile.
Here's the hard lesson. Liquidity is basically just a shared belief, a collective illusion. And in a real panic, that belief completely evaporates. The overnight loans in 1907? Gone. The bids on the crypto order books in 2025? Vanished. The ability to sell when you want to is a privilege, not a right, and it is always the first thing to disappear in a crisis.
Now, this is a massive point, especially for the DeFi world. Your risk isn't just in the coin you're holding, it's in the platform you're holding it on. Think about this 2025 scenario. The stablecoin USD was worth $1 pretty much everywhere except on the Binance exchange, where for a moment it traded at 65 cents. So anyone using it as collateral there got liquidated based on that false internal price. The infrastructure itself became the biggest risk.
And this all brings us to the final, really the biggest lesson of all. The tech changes, of course. We go from telegraphs and trust companies to fiber optics and DeFi protocols. But the human emotions underneath it all, the greed, the fear, the hunger for a quick buck, those things are timeless. The patterns of speculation and panic just keep repeating, only now they happen faster and on a global scale.
So we'll leave you with this question to think about. In 1907, the system was saved by a man who could use human judgment, who could show mercy, and who could force a solution. In our 2025 scenario, the system was just ravaged by automated rules that executed without any context or discretion. As we keep building our financial future on code, it's really worth asking yourself, in the next big panic, who would you rather have in charge?